What do we look for when we're looking for things to finance? We look for companies that have thought clearly about each of those stages of de-risking, each of those stages of value inflection, and have considered a project that is both a scientifically novel idea that addresses an important unmet need, right? So you have these two anchor points at each side of your value creation spectrum. But along the way, what are the key experiments that you're going to run that provide de-risking?
This is Real Pharma, your podcast for real conversations with pharma pathfinders. In every episode, you will hear from an industry insider who has a story to share that goes beyond the headlines. No spin, no sacred cows, no hidden agendas, just stories and the people behind them. Now, here are your hosts, Dr. Nari Oh and Ian Wendt.
Welcome to another exciting episode of Real Pharma. I'm your host, Nari Oh, joined by my co-host, the ebullient Ian Wendt. And today, we're joined by a distinguished guest in the Biopharma venture capital work, Jim Trenkle. Currently a partner at Novo Holdings, Jim has an impressive track record in venture investments. His journey in this field includes leadership roles as the head of investments at Sanofi Ventures and vice president at Pivotal BioVenture Partners. Beyond these roles, Jim has served as a board member for several innovative biotech companies like MapLight, Glycomine, and Thorini Bio, among others. With over a decade of experience at Gilead Sciences and a PhD in organic synthetic chemistry from MIT, Jim's deep expertise in both the scientific and business aspects of biopharma is truly impressive. We're thrilled to have him here to share his insights on the venture capital perspective in biopharma. Welcome to the show, Jim.
Thank you. Thank you, Nari. Thank you, Ian. It's a pleasure to be here.
Yeah, welcome. Thank you for joining us. Yeah, wonderful.
So, Jim, VC or venture capital has a little bit of this mysterious ring to it for a lot of people. And I think we all know some of the terms, but I would love for you to explain to us a little bit more from the bottom up. What does that even really mean, VC? We know it has something to do with funding. It's very important for biopharma. But can you help us explain and understand some of these terms and the definitions? So I like to think of it as it's almost like you're growing a tree. So you have these different phases, maybe. And actually, I think one of them is actually called seed rounds. So there's that.
Indeed.
Yeah, that's that parallel. So can you explain a little bit, what does VC really do?
Yeah, of course. No, thank you. And happy to give any clarifications as we go along here. Biopharma venture capital, will be the focus here today. So probably some pieces that would distinguish some of the specifics from, say, tech VC. One of those being that really throughout the life cycle of the companies we invest in, they consume capital. They don't create any. There's no commercialization of product for the most part. There's some exceptions to that. So maybe we just start with that as the vast majority of what I would work on would be research or development stage projects that need capital to run important experiments. As you said, there are various stages of investment. Seed stage capital would be really initial company formation, be able to bring in management teams, run initial confirmatory experiments. Perhaps you have a project that has been started inside of an academic laboratory. You would like to confirm that those experiments repeat. Sometimes they do not for various reasons. And then you can be off to the races in terms of raising larger and larger amounts of capital as you advance these scientific projects into preclinical development, eventual toxicity studies to confirm a safety margin before starting clinical development, and then through the stages of clinical development that'll be familiar, I think, to many listeners, phase 1, phase 2, phase 3, and eventual commercialization. I'll come back to that in a second. As you can imagine, each of these stages are going to require larger amounts of capital. The experiments get more and more expensive as you move from preclinical into clinical settings. And so that would be the reasons for staging capital into these distinct financing moments: seed, Series A, Series B. And eventually, you may take a company public through IPO or look to be acquired by a pharmaceutical company. And so that's probably sort of VC 101. Along the way, investors like myself or Novo Holdings, in exchange for the capital we provide, would look for equity in the company, so an opportunity to share in the upside for the ones that are successful. as well as some manner of shared control with management that often takes the form of a board seat. That for large and sophisticated investors is often a prerequisite for investing. And we hope that that is a synergistic relationship where our own experiences can be helpful beyond simply the capital we provide. And so that's really the bargain that's struck between the entrepreneurs and founders that really are doing the hard work and investors which are looking to support that hard work and hopefully be value add outside of the capital we provide.
Okay. I'm going to ask a follow-up question. Though you left out a term that also is often mentioned, which is angel rounds or angel investors. Can you just kind of give us the sequential terminology here? So we start with?
Sure. So angel rounds, it's really another name for seed capital that specifically looks to friends, family, high net worth individuals to step in and put the first maybe $100,000 behind a company, or a few $100,000, depending on sort of the stage of angel investing that you would look for. Seed, in these numbers, I wouldn't take, there's no book that's going to point to specific numbers, but just directionally, a few $100,000 to a few $1 million, oftentimes, as I said, to repeat some initial academic experiments, then seed at Series A, Series B, and C. You'll also hear terminology like a crossover round stated that specifically implies an intent to go public. And so you might look to bring investors in that both play in the private and public markets so that you can support an IPO. That crossover round really takes the name of another. So instead of saying it's a Series C, you could call it a crossover round. But it is, if you were to go look at, say, legal docs associated with the shares you bought, they'll say Series C preferred shares. They wouldn't say crossover shares. That's really just a nomenclature of financing strategy than it is anything that has real legal meaning.
And then what happens after Series C?
Oh, you could have a Series D. You could have a Series E. So if you remain private, you could have as many private rounds as your company demands. Going public, once you're a publicly held company, right, then it's traded on an exchange like the NASDAQ. And then you've really diversified your share base out of only dedicated life science venture investors like Nova Holdings into really anyone that wants to buy on the public market could step into investing in that type of company. And that would be then a chance as a company, say, continues to grow and grow in value for your early stage investors to be able to find liquidity or to be able to sell some of the equity that they generated initially to make returns and be able to go find the next great company you wish to invest in.
Great. Thank you so much. I think that was a really nice definition of a whole spectrum of terms that everybody kind of knows, but you put it very nicely in order.
Great.
I only have one more term, though, I wanted to add in because I think this is one that we've heard of, maybe unfortunately, but it comes up. Help us understand what a down round is.
Right. So you're buying shares and equity in your company at a agreed upon price per share into each of the financing rounds. What you'd like to see as you build value in a company over time is that later investors will pay a larger price per share for the company. Now, these are discrete transactions, right? Series A, Series B, Series C. So it's not an ongoing exchange at something like a NASDAQ. These are specific financing rounds where a portion of your company is being sold for an agreed upon price. It does happen that for reasons that could either be associated with the company's ability to perform, the quality of the data generated, whether or not that data met expectations, that you need to finance at a lower valuation than your lower price per share than your most recent round. And sometimes it can be due to the nature of capital markets. Some of that we've been experiencing lately, which is in a whole discussion itself, and maybe we can come back to that as the conversation goes on, or happy to get into it now.
Well, actually, that's a good setup for exactly where my next question was going. I'd like to talk a little bit about just kind of the landscape maybe that we're in right now in terms of biotech funding. Here's some stats I came across, and maybe you can just reflect on these, but this is some data from BDO, which publishes some good research in this area. But according to BDO, there's a total of 104 biotech firms completed IPOs. This is in the US in 2021, which I believe was a record number for the sector, represented a significant increase compared to the previous 2 years. However, by 2022, this had declined to just 21 companies going public. And this is in the biotech sector. So while 2023 2023 IPOs increased over 2022, it is still lower than what was achieved back in 2021. So we still haven't gone back to that peak that we saw just a handful of years ago. And then valuations similarly were under pressure in 2023. Last year, overall biotech valuations dropped by about 30%. The valuation specifically of companies with assets in the preclinical phase and phase one declined by 69% and 45% respectively. And this was as of early January 2023, so compared to the prior year. The thought is that this trend reflects a shift back to maybe more traditional standards for investment, emphasizing the strength of the clinical data, for example. Maybe that wasn't entirely true in 2021 when there was a lot of money out there. So here's my question. In your view, what is the current state of raising capital for biotech startups in 2024? And what's your perspective on how the landscape has changed over the last handful of years, especially, in light of global events like COVID and some of the technological advancements that we see now, for example, AI supporting drug discovery and things like that?
Yeah, there's a lot we can unpack there. Maybe I'll start with just the financing environment itself. And so really, as I think it's probably broadly appreciated, venture capital investing is a pretty risky business. Life science venture capital investing would represent an even riskier set associated with VC in general. And so if you're asking for investment to occur, you're looking for that against the background of a risk-free rate, or what you can turn a dollar into with essentially zero risk incurred. And so that's usually pegged against sort of the Fed rate or sort of T-bill yields. And as you say, they really, in order to stimulate the economy, had lowered interest rates nearly to zero, I think 0.67% throughout most of 2020. Today, sort of north of 4% for a 10-year yield. And so the amount of value you need to achieve for given risk then goes up accordingly. And so that creates some headwinds towards capital market access. And you see that most impacted on the IPO, right? Because that's then more of a generalist investor who has the opportunity to put their capital into whatever sector they wish, right? They don't have to go life sciences. That has been reflected in the amount of private capital that's been deployed, but even more so in the amount of public market access. And so we do see that continuing to percolate through the system. That means that there's been a larger percentage of capital put into our existing portfolio companies since they can't access the public markets. So you're carrying them further and longer than we were doing in 2020, 21, or 22 even. Since you're looking for existing investors to carry a larger load, that oftentimes comes at the expense of step-ups in valuation. And then when you do see the IPO market opening, which we do now, there is an expectation for what that price or valuation of company when it goes public will be, right? So these are money markets that have gotten used to valuations for companies which go public in a tight band. So, okay, sort of what's your standard comp for going public, say, call it $450 million pre. There's plenty of companies that exceed that, but that's sort of your going in assumption. And so if you're sort of solving to that number when you go public, that creates downward pressure on the private. If you have to add more rounds and still land at the same number, that leaves less room for upside on private investors along the way. I would say if you look at total financing amount, if you look at private venture-backed healthcare financing, this is a bellwether for where this is going. In 2023, it was 23% below total capital in for 2022. It was 42% below the amount of capital that went in 2021, but still 30% above where it was in 2019. So I think what you're seeing is a bit of a flush out in the system due to that lowering of rates for a couple of years, COVID-driven, stimulus-driven. And I think we're at the inflection point where we're starting to see it return to normalcy. I think we could look forward and think what we think 2024 will look like. I think we'll see IPO markets continue to reopen. I think we'll see the amount of efforts that have been put in private companies really start to get capitalized on by companies going public. And I think there's been an enormous amount of innovation that's been financed that I see really having an opportunity to drive a lot of value for the world, for patients, and for the investors that have managed to stick around through the tough times.
It generally sounds like good news then. I mean, are you feeling generally optimistic, at least looking at 24 versus 23 and 22? Is that fair to say?
I am feeling optimistic. I think there's a question of the amount of optimism that is out there, will that be met? Will we see interest rates drop, or will they hold steady at the Fed and that will have an impact? But I would say the worst, at least in terms of this biotech downturn, in my view, is behind us.
Well, good news. We all like to hear that. Yeah.
Yeah, absolutely. So, Jim, you mentioned earlier that obviously VC is high risk and biotech VC is especially high risk. What are some of the unique factors or challenges that lead to that sentiment? And how do you then evaluate and take into account these factors and challenges when you consider an investment?
Probably the number that I most often like to quote when I think about the challenges associated with biotech in general, and then that reflects on capital allocators and how they think about managing risk and having returns, is the success rate from a development project that you can get to IND. And there's, of course, many projects that fail before they get to IND, which represents a lot of our portfolio. So you have an IND, what does it take to get a drug approved all the way to an NDA? And the success rate there has been fairly stable for as long as we've been measuring it, hovering around 9 or a little above 9%. So that means 90+% of your projects that you bring forward into an IND, keeping in mind that we actually don't have good data on how many projects fail pre-IND, but from my own experience, it is the majority or the vast majority. 90% of them will never be commercialized or provide any long-term value to patients or investors. And so that backdrop is really part of what I mean when I say that this is a difficult space to finance. That also reflects on the expense that one has to spend to really get to approval. There is each of these stages of clinical trials, and so each of those are quite expensive. And folks like Tufts have run numbers to see what the risk-adjusted cost for a new drug to be brought to market is, and it's north of $2 billion, something like $2.5 billion. And there are those that look at that as something of a conservative estimate. So what do we look for when we're looking for things to finance? We look for companies that have thought clearly about each of those stages of de-risking, each of those stages of value inflection, and have considered a project that is both a scientifically novel idea that addresses an important unmet need, right? So you have these two anchor points at each side of your value creation spectrum. But along the way, what are the key experiments that you're going to run that provide de-risking? So at each step along the way, you have an animal model that really recapitulates the disease. Do you understand both what it tells you and what it doesn't tell you? Do you have a biomarker that you can look for in early clinical development in phase 1 before you really need to get to clinical POC? Because that's going to be cheaper than having to run a larger powered clinical trial to really see benefit on the symptom of interest, right? It's going to vary by disease area. And have you aligned your financing plan to really generate each of those pieces of data and align them with the seed, Series A, Series B that we talked about before? Because I think that's part of the setup, the financing setup that's necessary for healthy and well-planned biotech companies to flourish and for investors to really understand, okay, here's why you're raising $30 million. You're going to run these key experiments. We're going to know these data at the end of those experiments. That's going to enable us to do your next financing round. You have an idea of what that might look like today, room for adjusting along the way, and how much capital you'll need at that stage, and hopefully at a higher price per share than what we're paying today. Otherwise, why invest now? You could wait to invest later.
And what are the hot areas right now that everybody's looking at? There always seems to be these trends that come and go. I know over the last handful of years, oncology in particular has been associated with a lot of the IPOs and a lot of the capital investment. And I'm wondering, you probably lately are getting a lot of calls about GLP-1s. Maybe there's other things that are hot ticket items, but any trends there that might be interesting?
We have seen a rise of product-focused investing of late and a little bit of a shift away from platforms alone, a recognition probably of the risk appetite. Platforms, sometimes you can spend a lot of money before you start to really generate products that'll be of value to patients. And when capital's been a little bit tighter, there's been more of a push towards companies to tone down spend on platform for platform stake and focus on what the enumeration of that platform could look like. From a disease area perspective, I agree with you. Metabolic has grown. Not hard to see why, based on the capital being generated or the profits being made in the GLP-1 space. But I would also say cardiovascular, I&I have grown as pharma has focused on larger indications, less rare indications, higher prevalence. And there's been, as there often is, a space for private capital to rush in where pharma has stepped away from. So areas like neurology have been underfunded in recent years by pharmaceutical companies. And so private biotech can pick up that mantle and, in the cyclical nature of things, drive innovation that then pharmaceutical companies become interested in buying. And you can see this with acquisitions like Karuna or Cerevel late last year, right? And so you continue to see a lot of innovation in the neurospace.
Yeah, thank you.
So, Jim, you said there's no, or it sounded like there's really no playbook, right? Nobody will tell you this is exactly what you have to do to get from A to B to C to D. But you just gave us a little bit of an idea of what are you looking for in companies that are coming to you for funding. So they have to have a very well thought out plan and has to be really methodical in terms of the different stages along the life cycle. But is there anything else that you could share with companies in terms of what does good look like and what are some of the pitfalls that people should avoid? Especially because it seems that now after the exuberance of maybe 2021, when capital was abundant, standards, probably rightly so, are a little bit higher and stricter. And so it maybe takes more to clear those hurdles.
Yeah, I think that's right. The specifics really do come down to context of each individual company, but there are some watchwords or waypoints to focus on. And I think that probably reflect on some of the themes I've just mentioned. So if we think of platform companies, and I think many times the scientists and founders associated with this company get really excited about their technologies. And I that enthusiasm is important to continue and to leverage. I think as one looks for how much to build out and broaden a platform and think of something that a tech VC would say, build a flywheel, that is, I think, always a bit of a challenge in this space. And I think the best platforms have always looked towards the key problem that they're going to solve, that they put forward a product and then focus their development energies on that product and think about if there's more down the platform stack that they want to do, the way that the first product would support de-risking of future second and third products. So if you have a PROTAC, right? So you have a bifunctional small molecule that helps degrade proteins that, say, have been undruggable targets in the past. So this is Arvinas, right? Had been maybe the first well-known company to really leverage Craig Crew's work on that. You could see building out an understanding of the pharmacodynamics associated with degrading proteins. You select your first protein, you figure out what to do from the E3 ubiquitin ligase side of things. So that's your degrading technology. And you look for what the linkers need to look like and what the protein binding side needs to look like, the thing that actually hits your target. Now, product number one should teach you a lot about product two and product three. And I think that's an example of a platform that could be really powerful and done well. And we'll see, I think there's exciting variations on that theme that one sees for other bifunctional molecular platforms, right? So I think that's a space where you could work on. But then there are others where I think it's less clear how your first enumeration really tells you anything about number two or number three. You haven't really built out a platform in any way other than you've got this really cool technology you're applying to product one, but you'll be starting from scratch in product two, in which case I think that's harder to tie together as a complete package for investors. That's probably one piece that I would think about focusing on.
So it's a little bit like scalability almost. Is it a one and done, or is there more to it so you build more runway? Seems like that's an easier sell.
Yeah, I think that's right. I mean, there's always value in having some diversification of risk in any company's portfolio. So I'm not saying each company should go and be a one product company. That's not the takeaway I would take here. But I would say, this notion that platforms will be able to drive value in their own right is a little bit harder sometimes to see. And so it will come down to what's the product that will solve a clear unmet need for patients. And so getting that balance right is important. And I think is something that is reflected in a lot of investors' thinking today, and certainly in mine.
One follow-up question on that. We haven't really talked about, you mentioned the unmet need. What unmet need does this solve? But what about patient-reported outcomes, cost effectiveness, commercialized considerations? Is that something that you look into as well? So we've seen some very high-profile examples of drugs that were approved, but then failed to really succeed in terms of convincing payers to reimburse for it. Is that something that figures into your work at all?
It absolutely does. I mean, and that's the sort of bookends that form the base of every investment that we start with. What's your approach, your technology, your medicine that you're planning to put in front of patients, and what's the unmet need you'll solve, and how it will be paid for, bought by pharmaceutical companies, et cetera. And so if you're stepping into an investment without understanding that treatment landscape, you haven't really done your diligence. And so I think that is very important. I would say, for my part, personally, I focus on therapeutic investing. Nova Holdings as a whole makes investments in many different areas, including med devices and spaces outside of specific therapeutic investing, or even insurance companies or payers and providers, things along those lines. I think through a therapeutics lens. So I'm not investing into companies that are looking to solve a health economics outcome research issue specifically, but you do need to be mindful of Inflation Reduction Act impact on what that will mean for starting in a rare indication and then expanding into a less rare indication. There are pricing impacts as one looks to regulation. I think there are payer pushback in spaces that have been interesting to see, right? If you think, what's the average amount of time that a patient stays on an individual insurance exchange? I don't have a specific fact in front of me, but it's maybe 2 years. And so if you're thinking of diseases that are slowly developing, you could expect a larger amount of insurance pushback, particularly if it's a high upfront cost for something that's a short defined duration of therapy with all the benefits seen back end. Then I think that has been a space where we've seen higher payer pushback and more problems with realizing value, even if it is there for society. If we try and think about curative cell therapy moving into inflammatory spaces, right, or autoimmune spaces, where you could suddenly see a much larger number of patients potentially being treated and cured of, you see these early responses for lupus, but maybe that can be applied to other higher prevalence indications. These are going to be potentially one and done or very few treatments. And so what will that look like on a commercial? So that would have to show up in our risk assessment from a market side.
So one of the things I'm kind of curious about is a little bit of detail on your career path. I think it's been maybe atypical in some ways. So as I understand it, you've held a variety of different roles working for, I think, mostly medium to large size pharmaceutical manufacturers in kind of commercial planning space. But here you are in a very different world. Certainly there's some overlap in terms of expertise, but that's probably that transition I don't think is too typical. And just talk us through that a little bit. I think there's probably some folks listening that might be curious about how that came about and how they might consider the same thing. But what was your path like?
Certainly not the one that I would have expected when I started out, but I think I've always been guided by a desire to find work that I think will have a deeper impact, both in the end goals of the work itself, but also in the day-to-day process itself. What does the work feel like when you're in the thick of teams and feel like the work has a meaningfulness to the organizations that I've been in? So I started my career, as you led with at the beginning, with a PhD in organic chemistry, and at the bench as a medicinal chemist at Gilead Sciences. I worked on the hepatitis C discovery set, was fortunate enough to be on a couple of projects that moved into the clinic. And there was a key moment there, where I was offered the opportunity to step out of the lab and move down the road at Gilead into a project and portfolio management role. And that was a pivotal decision for me about thinking about being a lifelong learner and look for ways to continue to broaden my horizon and what I saw as broadening my impact. So I moved in that direction to learn, where do these projects that we work on at the bench, where do they go? How do we select which projects we think are important to work on? How do they get developed clinically? What's our longer term portfolio strategy? It certainly, I think, surprised some of my colleagues in research, because I think they saw, rightly so, that there was a lot of room to grow as a medicinal chemist, and you never get to walk the path you didn't walk. But I would say that opportunity to continue educating myself in new horizons has been part of my guiding principles. And it led me from there down to, as you say, commercial strategy on the back of doing an MBA and nights and weekends at UC Berkeley, and then eventually into venture, which I felt tied together each of those disparate parts of my career. I'd worked at the bench as a researcher. I'd worked on the development projects in hepatitis C and had gotten some drugs approved. Part of the larger team had gotten some drugs approved. And then it had a chance to be part of the commercial strategy associated with them. And I thought, what an interesting way to tie those pieces, those disparate pieces together, thinking about research and development and value capture from a venture investor. And then really in an entrepreneurial environment where you can feel that impact on a day-to-day basis, because the teams are small and decision-making focuses through a few key individuals. And that's been very rewarding in its own right. So it's been fun.
It's really fascinating. So again, a really interesting path that you've taken, and who knows what you're going to do next. We'll have to bring you back after the next big move. Were there any particular challenges for you to make this last move into venture? What were the skills that really stood out when you took that step? And what kind of advice would you give to people that are interested in making a similar move?
Yeah, I mean, I think there was a lot to learn being an investor versus working in what had become a relatively large biotech company by the time I left Gilead was a very different setting. A certain amount of humbleness stepping in there and recognizing that this is a new place to be learning in a lot of unfamiliar territory. It's also one of the pieces that I had to rewire my brain about was when you pursue a PhD, you pursue excellence in a particular field, deep domain expertise. And as you look to broaden that, and each step has gotten broader and broader, you become less and less a domain expert and more reliant on pattern recognition, tying together experiences from one very different project into the one you're working on now. So you have to be, I think, comfortable with that change and that lack of expertise. So you know who to ask, know how to listen, know how to be smart enough to be dangerous, right? But ultimately having to make decisions that really impact what you're working on. You can't be frozen in indecision. So you have to sort of be comfortable with knowing what you know and having a sense of what you don't know.
All right, Jim, you basically epitomize you're going from very, very deep in one area to gaining more and more breadth. So that's been really, I think, a theme throughout your career so far. And I want to ask you a little bit of a more controversial question, maybe. A big event for industry was Theranos, where there were many things that happened that shouldn't have happened. One question about that is, as somebody who works in VC, what is your responsibility in terms of evaluating a company like Theranos, where there were a lot of promises were made, things definitely were not always what they seemed? What kind of responsibility do you have to try to dig deep into that? Is it possible? Is it something that's recommended or necessary? So what is the role of VC in something like that?
I'd probably start with saying we're investing in life sciences and healthcare. And so there are patients' lives at the end of the line. And so there'll be hucksters in any field, but it's particularly incumbent for the enablers in this setting to really sniff them out. So I think you have to start with that frame of mind when we talk about Theranos. I think in particular, Theranos in that entire story highlights the importance of doing deep diligence. So I did just finish telling the audience how that shift from being a deep domain expert in an R&D field into focusing in a broader landscape of therapeutic opportunities really lessens one ability to go really deep. But I would say there's that, and then there's the who invested in Theranos set. These were sort of non-healthcare dedicated investors or family offices. They were focused on some of the star power there, or household names, right? Mainly diplomats or government, military names, George Shultz, Henry Kissinger. Not really thinking about an understanding of, maybe I wouldn't have an understanding of specific blood prick technology as one if I were starting on a pitch. But by the time I would invest in Theranos, if I were to have gone that direction, I would have known as much as I possibly could and have talked to experts who knew the things that I don't know, right? You would look to really engage in the data. You should never be investing in a black box. You need to understand the science behind what we're working on. We're not here to invest in magic in any capacity. And I think there was some magical thinking that was being applied at Theranos and really set up by Theranos management to try and keep non-domain expertise away from the boardroom, and an unwillingness to share data. Those would have been all sorts of red flags for us that would have made us put our pencils down super early. And so I think that really gets at being careful not to follow a herd or be a momentum investor. And you see this in some spaces where the hype has gotten to a fevered pitch and there's a lack of stepping back and thinking about the fundamentals. And I don't think you have to be a deep domain specific expert to be able to do that. You have to have sufficient expertise and be able to know what you don't know and look to others to help and educate you before you make an investment.
You mentioned a couple of red flags, which I think I understand. I wonder how somebody who's already in this domain, somebody like yourself that's kind of dedicated to as a biotech capital allocator, if you look at the star power of a board, like if that comprises the majority of the seats on the board, you mentioned, I think Schultz and I think Arianna Huffington, and there were others, notable names like that sat on the board. Is that a red flag by itself? And the type of folks who are also investing. So for example, you mentioned some family offices that may not typically invest in this sector. If a lot of the source of funds are coming from those type of profiles, is that also a red flag? Like, is somebody like yourself going to step back and say, well, this looks atypical, or those are warning signs?
Yeah, I think early on in a company's formation, when we talked about angel investing rounds, for instance, there could be investors that would invest on recognance, right? I know this person, I trust them in general. I'm going to write a few $100,000. Maybe if you've got some really wealthy friends, $1 million or $2 million, and you can make some interesting headway on early experiments. If that's continued into a company's later, larger financing rounds, you have to really wonder what the setup is about. Because as I mentioned early in what we look to do at Nova Holdings, and I'd put any of my top quality venture brethren in the setting, would be to add more at the board and at the investor set than just the dollars that we bring. Smart companies that look to build a product that's going to be of the highest value in the long term understand that. They look for investors that we get to know each other in the diligence process. This is a two-way dating scheme, right? So, in the end, we're going to work together at the board. So hopefully and reasonably respect me, as well as I get to know and reasonably respect you as a company that I'm considering investing in. And I don't think that was the kind of setup that Theranos was ever looking for. They weren't looking for somebody who could really add some technical value or domain value. They were looking for star power and then somebody who would stay in their lane and out of theirs, right? And I think that should have become apparent much sooner than it did for Theranos.
Well, I wonder if they specifically were avoiding folks with that technical insight. I think maybe there's an argument there because they didn't want anybody poking too hard at their value proposition. At least one explanation I've heard.
Yeah, and I think that a lot of their financing predates a bit when I started venture, but we did overlap some of their venture rounds when I had stepped out of Gilead into my venture roles, and I never saw them. And most funds that I talked to, they didn't come and try to seek capital from, I think exactly for that reason, Ian.
You've mentioned a few times, obviously there's a high risk, potential high reward nature to this business, of course. And I'd just like to reflect a little bit on what we've seen in 2023. And of course, this happens every year. But in 2023, there was a notable increase in company closures compared to the previous year. It probably mostly reflects the challenging financing environment and obviously the complexities of drug development. Among notable closures were companies like Antios Therapeutics and Tessa Therapeutics. Rubios Therapeutics is one that underwent significant strategy changes to try to get ahead of some of these market factors that I mentioned, but they ultimately ended up dissolving as well. And the closures really spanned across a variety of different disease areas, modalities. Both private and public companies were certainly affected. So knowing that we're all in this high risk, high reward kind of environment, are there any notable investments, and you can be as specific as you're allowed to be, but that didn't go as planned, like a little bit of a postmortem, sorry for the term, but of course you said over 90% don't make it to commercialization stage. So there's a big graveyard of companies that we've probably all quickly forgotten their names as we move on to a new round of companies that are doing new things. But can you walk us through a little bit of what some of those failures look like and why? Like what's typical there?
I'm happy to do so. I might stay more general than getting specific because I always hate to throw a specific company underneath the bus in any capacity. But I would say companies fail regularly, projects fail even more regularly. This is a fact of the job. In my view, it's both a necessary and normal hazard and sort of comes with the territory. I think there are failures in particular that I don't take well, and I think other investors would probably share the sentiment, which is if you don't run the right experiment, then you can be stuck with data that you don't know what to make of. I mean, shades of gray in data is normal. That can't be avoided. But if there was avoidable mistakes in terms of patient population you selected, the study you ran, those are the parts that hurt because now you're stuck with a negative or a middling readout. And that's a very hard position to be in for raising more capital. I think even worse is failure to get the data. So sometimes you can see insiders or management be hesitant to take additional capital. They want to avoid dilution. They don't want to sell too much of their equity at the price you're offering today. But inevitably, things take longer and cost more money than we predict at the beginning. I've never seen the opposite be true. And so you really don't want to build a bridge to nowhere. So you're 3/4 of the way through your experiment and you're asking for additional capital. And now if you ask new investors to step in, you're asking them to step right in front of a readout. And that's really hard to do. So that part to be avoided at all costs. And there can be tranching mechanisms one can put in place to try and find a negotiated middle between, no, I don't want to raise all this additional capital, but if you do need it, then we have this, right? So there can be ways you can set up these investing rounds to try and solve that problem. And I think maybe the last piece I would say is what I tried not to learn. I try not to learn to not invest in places where I've lost money before. And I think you do see this. You see repeat investing into a space as a theme for investors who've been doing this for a while. Oh, I made money in this space. I'm now excited to go make money in dermatology again. Or I've lost money in neurology, repeat, so I avoid that space. That's the wrong lesson. If you can understand why you're consistently seeing failures in, say, neurology, you look to see if you can address those structural issues and pay it forward into a smart investment. So I mentioned Karuna before. That been an early investment from my prior fund. And that's a space, neurology, which has been, in psychiatry in particular, it's been considered relatively uninvestable due to higher than average failure rates. It's about 6.2% IND to NDA for psychiatry. So 30 or 40% below even the average. And so there was, I think, real consideration from Karuna's perspective of how to solve those problems, both in schizophrenia, which is the disease state that they were initially working on, have been higher than normal failure rates in part due to patients' unwillingness to be compliant in their medication. I think it's pretty understandable among schizophrenics, as well as the drugs themselves worsening some of the symptoms associated with schizophrenia. And so Karuna had solutions for both of these potential problems. They were running an inpatient trial. So inside of patients were held in a medical facility throughout the duration of the trial. And so no avoidance of medication was possible. So there was a higher degree of control in that setting. And the biology of the mechanism of action for Karuna's drug looked like it would improve these negative symptoms of schizophrenia as well as the positive symptoms. And so that turned out to be one of the most successful investments of my career so far. It was bought by BMS for $14 billion last year. And I think that's a space where if you understand, say, some of the structural challenges, you can potentially provide solutions in companies that you invest in rather than just avoiding a space altogether.
Great. Yeah, thank you. So
looking ahead, Biopharma is facing a little bit of an innovation deficit, arguably, and we're expecting significant revenue erosion from 25 onward, mainly because of patent expirations that are going to hit many of the larger and medium-sized companies. Ernst & Young suggests that the replenishment rate for the top 25 bio and pharma companies will drop more than 80% by 2027. So how do you see the VC landscape evolve, maybe influenced by technological advances? We mentioned AI, or by trends in the landscape that have more to do with therapeutic areas, maybe. I mean, you are sitting in the middle of one of the hottest areas right now. We haven't even really begun to understand all the potential implications of GLP-1s, for instance. It's been much further than what the initial focus has been. What are you excited about? What do you think is going to be attractive and to stem that downward trend?
I do think we're at an exciting time. I think there's been enormous advancements in enabling technologies, whether one thinks of imaging or deep sequencing from an understanding of pathophysiology of disease or development of understanding of how molecules will interact with proteins, either from an AI perspective, right, or from mass spec developments or abilities to interrupt these systems and really measure the impacts of drugs that we're developing. And I think that information provides an opportunity and a challenge. And I think there's a lot of innovation opportunities to leverage these computer systems to better present that data in a way that leads to conclusions or hypotheses. And then enabling technologies like gene therapy tools could be brought forward into the next set of not just gene editing, but RNA editing or other applications. We've looked at the opportunity for RNA editing through exon splicing as a particularly interesting way to try and solve the gene cassette that you can insert, where there's been AAVs can only insert a certain size of gene cassette. And so I think each of these technology developments provide opportunities to improve upon them and iterate in a way that's really powerful. And so what we look forward, what I look for in my perspective is why now? What's the moment today and what is the history that informs why now? So we talked about earlier in the episode, Arvinas having bifunctional molecules that perform two different business ends, right? You have the part that binds the protein of interest and the part that brings in the degrader. Well, that is a molecular feature, breaks all the rules. It breaks all the so-called rule of five, Lipinski rules in terms of size of the molecule, in terms of polar surface area, et cetera. But since we can break those rules and we can understand something about why we can break those rules, where can we break those rules again? What's the lesson learned? And so I think that piece from an innovation perspective, I could not be more optimistic around. And then from a capital perspective, as we've said, there's been enormous amounts of capital raised into the venture capital ecosystem. I think the synergy between what VC delivers, early stage innovation, bringing things forward into clinical de-risking, combined with pharmaceutical companies that really understand how to bring these to patients, how to scale the technologies that we generate in our early stage companies, I think is a healthy ecosystem. Pharmaceutical companies, of course, do their own research and development, and I don't want to minimize that, but the old trite statement is the NIH complex, the not invented here complex. And so there can be this view of we know what we're doing, we know how to do it best, which can calcify thinking or disease areas you focus on. And so I think there's a great opportunity for venture-backed firms and for private innovation to complement what pharma is doing really well. And I think for the benefit of society and really a lot of really interesting examples of that late, right? Moderna was a venture-backed company and wouldn't want to take anything away from biotech and Pfizer, right? But I would say having these mRNA technologies be brought forward by venture, we all benefited in that enormously with the development of COVID vaccines. And that's just maybe the most recent or most spectacular example. But I would say, really an important synergy of these two ecosystems.
Well, I think that's a great note to end on. I love the idea that you're more optimistic and there's a lot to look forward to, I think, in terms of the capital markets generally and some of the innovation that's going on within biotech. It's always exciting to see what's next and how this evolves. It's a bit of a moving target, but thank you for helping us understand that target a little bit better. But one of the closing questions I have for you, is there any bit of advice or maybe a particular mentor that has been impactful on your career or maybe your life that you could share with us as we end the episode?
There are many people that support one throughout your life, and I'd hesitate to point to one. But if I had to, I would really think of my dad, who had been professor of organizational behavior and then helped people with career advice throughout. That was part of his job. And so I think I benefited from someone who was always available to talk about how to think about a career and how to think about career growth. And some of the pieces of advice he gave me were to think about informational interviews. I've spent a lot of time in my career asking for the generosity of others to speak about what it is they do, why they do it, what's interesting and exciting about it. And I think that has been informative both for moves I've made and moves I haven't, and sort of an appreciation of how we all work together in this, not just biopharma, but sort of more broadly in a way that works as an economy. There's also a notion that you can do anything, but you can't do everything. And so ultimately you have to make choices and have some focus, but you can remake those choices. So you can work for a period of time, and I could spend 5 years pursuing a PhD to know how to make complex small molecules, apply that for 3.5, 4 years at the bench at Gilead, and not beat myself up too much when I decided to step away from it. I didn't have to. I was having a great time, but I felt enabled. I felt that I didn't have this sense of, I'm going to regret this always. There's a chance to learn something new and move onward. And I think follow that gut, follow your own internal compass on what gets you out of bed in the morning, what's going to continue to get you out of bed and make you fired up for adding value to the world. And so far, I've never really followed the initial plan or playbook. I didn't plan to come to venture. I think if you'd asked me, 15 years ago, what I thought of going into venture, I would have not known what you were talking about. And so, I think that's okay. Keep making it up as you go along. Just follow some core guiding principles.
Wise words from the two Mr. Trenkles, two Dr. Trenkles probably. So thank you so much for sharing that.
My pleasure.
Thank you. Yeah, I really appreciate the lifelong learner attitude. And I think we can all continue to learn and certainly admire that characteristic and aspire to take that on ourselves. So thank you for that. Thank you for the time. It was a really fun conversation.
Thank you, Jim.
I enjoyed it, guys. Thank you.
Well, that was a fun chat with Jim, and first time I had the chance to meet him. And I always find it very interesting and inspiring to hear folks that have managed their career in a way that's the path less commonly traveled, let's say. And I think his career path might qualify for that. It was interesting to make that transition and took on all the risks that are associated with it. But it kind of fits the VC profile, right? High risk, high reward. I think both in his role and how he's managed his career, that same dynamic exists. And obviously it paid off for Jim. So grateful for him to help us understand what can be a pretty complex area of life in biopharma, but certainly a really important one. That's the fuel that allows all this innovative research to be done and ultimately, hopefully, delivers new technologies, new products that help patients. So really interesting discussion.
Yes, I agree. I think Jim did such a great job explaining very eloquently some of the concepts and some of the thinking and pulled back the curtain a little bit for VC. And I also found it very inspiring that he is really able to use all of his previous experience that's very diverse and bring it together to be successful in his new role in VC. So it's great to see that. And I hope that it gives other people some food for thought as to how can they do something new, something different, and take that risk and really think about how their specific background and experience can, lead to something else that's great, just like it has with Jim. So it was a really fun episode, and I'm glad we had the time to talk to him.
Yeah, we'll put some additional resources in the show notes and maybe some information certainly on Jim and Nova Holdings. And by the way, they're probably the 5th largest capital allocator in the biotech sector in 2023, according to my research. So they're definitely a major player. So we were talking to somebody that certainly has deep knowledge, certainly a subject matter expert in this area. So we're lucky to get his time. Thanks for your time as well, Nari. Fun episode to chat through, and I look forward to the next one.
Good to talk to you, Ian, as always. See you next time.
Thank you for listening. Please visit us at realpharma.co for more valuable resources. Real Pharma is brought to you by Black Canyon Ventures.